If you connect the recent news about energy markets with developments in the e-consumer sector, an interesting pattern starts to appear. When people talk about rising oil prices, they usually focus on energy companies or the chemical industry. But in reality, the influence of oil prices goes much further than that. It moves through a long-cost transmission chain and eventually reaches everyday consumer products, including food, beverages, and dairy products. When you see food prices changing in supermarkets, it is often not just about agriculture. Energy prices are usually part of the story as Oil is not only a source of energy, it is also deeply connected to transportation, packaging materials, and many industrial inputs. When oil shipping costs increase, packaging becomes more expensive, and certain raw materials also become costlier. These changes gradually flow into the consumer goods sector. For food and beverage companies, the key question is whether they can pass these higher costs on to consumers. That ability often determines whether their profit margins shrink or remain stable. We have seen similar situations in the past. If you go back to the 1970s, the oil crisis created a period of high inflation and slow economic growth in the United States, a period that many economists later described as stagflation. During that time, the U.S. stock market experienced the famous Nifty 50 era, when many consumer and brand companies were highly valued because of their stable earnings. When the macro environment changed, those valuations eventually came down. But what is interesting is that some consumer companies were still able to maintain profit growth through pricing power and brand strength. That experience shows that inflation does not necessarily damage the entire consumer sector equally. Different segments can behave very differently. In today's environment, if oil prices remain high for an extended period, we might see a similar pattern of divergence within the food and beverage sector. Companies with strong brands or powerful distribution and networks may have more flexibility to adjust prices. On the other hand, businesses with weak differentiation may face stronger pressure from rising costs. From an investment perspective, rising oil prices do not automatically mean the consumer sector will perform poorly. Instead, they may create structural changes within the industry. The real focus should be on companies that can effectively pass higher costs through the supply chain while maintaining demand for their products. In other words, pricing power becomes the key factor. Over the long term, consumer industries tend to have relatively stable demand because food and daily necessities remain essential. Even while economic conditions fluctuate, people still need to eat and drink. That is why the deeper competitive advantages of companies such as brand strength, product positioning, and distribution networks often matter more than short-term cost shocks. Rising energy prices may simply reveal these differences more clearly.